Hello everyone and welcome back to our channel. If you're new here, don't forget to hit that subscribe button and click the bell icon to stay updated on our latest videos. Today we're diving into a crucial topic, the impact of inflation on investments. Inflation can significantly affect your investment portfolio, and understanding how it works is critical to making informed financial decisions. So let's get started. What is inflation? First, let's define inflation. Inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. In simpler terms, it's when your money doesn't buy as much as it used to. How inflation affects different types of investments. Stocks. Let's start with stocks. Historically, stocks have outpaced inflation over the long term. Companies can raise prices to keep up with inflation, leading to higher revenues and potentially higher stock prices. However, in the short term, inflation can cause market volatility. When inflation rises unexpectedly, it can lead to higher interest rates, negatively impacting stock prices. Next, let's talk about bonds. Bonds are susceptible to inflation. When inflation rises, the fixed interest payments from bonds lose value because the purchasing power of those payments decreases. This is especially true for long-term bonds. To mitigate this, investors often turn to Treasury inflation-protected securities, or TIPS, which adjusts for inflation and provides a hedge against it. Real estate is another asset class that inflation can affect. On one hand, real estate values and rental income typically rise with inflation, making it a good hedge. On the other hand, higher inflation often leads to higher mortgage rates, which can reduce the affordability of properties and slow down the market. Commodities like gold, oil, and agricultural products often perform well during periods of high inflation. These tangible assets tend to retain their value and even appreciate as the cost of goods rises. Investing in commodities can provide a good hedge against inflation. Finally, let's discuss cash and savings accounts. Cash is the most vulnerable to inflation because it loses purchasing power as prices rise. While savings accounts and certificates of deposit, or CDs, offer some interest, the returns are often lower than the inflation rate, leading to a net loss in value over time. So how can you protect your investments from the eroding effects of inflation? Here are a few strategies. Diversify your portfolio across different asset classes. A mix of stocks, bonds, real estate, and commodities can help balance the risks and rewards associated with inflation. Inflation-protected securities. Consider investing in inflation-protected securities like TIPS. These bonds adjust their principal value based on inflation, ensuring your investment keeps pace with rising prices. Real assets. Invest in real assets like real estate and commodities. These tangible assets often perform well during inflationary periods. Dividend-paying stocks. Look for dividend-paying stocks. Companies that consistently pay dividends are often more stable and can provide a steady income stream that helps offset inflation. Shorter-term bonds. Opt for shorter-term bonds over long-term bonds. Shorter-term bonds are less sensitive to interest rate changes and can be reinvested at higher rates if inflation significantly impacts. In conclusion, inflation can significantly impact your investments, but with the right strategies, you can protect your portfolio and even capitalize on inflationary trends. Please remember to stay informed and regularly review your investment strategy to ensure it aligns with current economic conditions. Thanks for watching. If you found this video helpful, give it a thumbs up and share it with your friends. Don't forget to subscribe for more financial insights and tips. Until next time, happy investing!